The covered stock strategy, also commonly referred to as a covered call, is simple but very powerful, and it's often the very first option strategy for many investors who are venturing into a more active trading style. The covered stock strategy is a great way to improve your probability of profit on your existing stock portfolio, and also enhance your returns by collecting option premium against your stock positions. Let me show you how this works. The covered stock strategy is simply just a combination of long stock and a short call. So you'd buy stock and then you would sell a call option against the stock. Let's look at an example to see how this works. The current price of stock XYZ is $75 per share. And you can also see the prices of the options here with, let's just call it 30 days to expiration. For this strategy, we're going to buy 100 shares of stock at the current price of 75, and we're also going to sell a call option. We can sell any strike option we want, but for this example, let's say we sold one contract of the 85 strike call for 2. So we are long stock at 75 and short the 85 strike call at 2. Now let's look at a few scenarios to see how this trade works. Alright, so we are long stock at the current price of 75, and we sold the 85 strike call against the stock, and that expires in 30 days from now. Okay, scenario 1. Let's say the stock goes from $75 per share up to $85 per share. So it goes up and ends up right at our short call strike of 85. If the stock is at $85 per share, and the strike price of our option is 85, then our option is at the money. But it still isn't in the money, right? It doesn't have any intrinsic value. So the option we sold is now worthless, because for it to have any value, it would have to be in the money and have intrinsic value. So now let's see what our profit or loss would be on the overall trade if we were to exit this position here at expiration. The stock is now 10 points higher than where we bought it, so we made 10 points on the stock, and the option that we sold at 2 is now worthless. So we made 2 points on the option. So our total net profit is 12 points. Or in this case, we kept our position size at 100 shares and one contract, so we made $1,200. And that's how we look at it. We treat this as one trade. And we are really just concerned with the net prices of the spread as a whole. The combination of long stock and short call is called covered stock. And our net entry price, or net cost of the covered stock, is 73, right? Because we paid 75 for the stock, but we collected $2 in option premium, so 75 minus 2 is 73. And our net exit price is 85 minus 0, which equals 85. So rather than monitoring the prices of each individual leg of the trade, we can just monitor the prices of the spread as a whole. So we bought this spread at 73 and sold it at 85, so our net profit is 12 points. Okay, so the stock went to 85 and we made 12 points on this covered stock position. That's great. If we were to have just bought stock, we would have only made 10 points, and by selling the covered call, we added a full 2 points to our profits. But here's the thing, this profit of 12 points is actually our max profit on this trade. Even if the stock goes to 100 or 150 or any number above the strike price of the call, we will still only make our max profit of 12 points. The reason is because if the stock goes up and goes well past the option strike price, then the losses on the short call will cancel out much of the profits on the long stock. Right? For example, if the stock is at 90, then the call would be at 5, since it's 5 points in the money. So we will have made 15 points on the stock and lost 3 points on the short call. So our net profit is still just 12 points. One more example, let's say the stock doubles in the next 30 days and goes to 150 per share. That's obviously very extreme and isn't going to happen that often, but If it did, the call would be worth 65 since it is 65 points in the money. So we will have made 75 points on the stock, and on the call we sold it at 2 and bought it back to close it at 65, so we lost 63 points on the call. So a profit of 75 minus the losses of 63, and that means our net profit is still just 12 points. Basically, the price of the spread as a whole can never go higher than 85. Or in other words, it can never go higher than the strike price of the option. So to sum it up, if the stock goes through our short call strike, then it's no harm to us at all, other than the fact that some traders may beat themselves up that selling the call capped their huge gain they would have had. But that's an amateur thing to do because it's all hindsight anyways. Really, we want the stock to go through our short call strike because that means we make the max potential profit. Okay, scenario 2. The stock doesn't do much, and maybe it even goes down a little bit and ends up at 73.50. If we bought stock at 75 and it's now at 73.50, then we are down $1.50 per share on the stock. And since the stock is below our short call strike, our short call is out of the money and is now worthless. We sold the option at 2 and it's now at 0, so we made 2 points on the option. So the net profit on the entire trade is 50 cents because the profits on the option more than offset the losses on the stock. And that's what's so cool about selling the covered call against the stock. It cuts down our cost on the trade, which therefore improves our break-even point. If we were to instead just trade the stock, then our break-even point is simply right where we purchased the stock. If it goes up, we make money, and if it goes down, we lose money. But selling the call against the stock allows us to have a better break-even point. In this case, our break-even point is at 73. So even if the stock goes down a little bit, we can still make money. So yes, selling a call against our stock caps our potential profit, but in exchange for that, we are rewarded with a better break-even point and therefore a better probability of profit. Okay, scenario 3. How do we lose money? Well, we lose money if the stock is anywhere below our break-even point, right? Let's say the stock goes down and ends up at 67. If this is the case, then we lost 8 points on the stock, but again, the call that we sold at 2 is now worthless, so we made 2 points on the call. So on the overall trade, our net loss is 6 points. Now we lost money, but we lost less money than if we were to just buy the stock without selling the covered call. So that's how the trade works. Basically, in this example, we are always going to be 2 points better off, unless the stock skyrockets to the upside. In that case, we will just simply have missed out on the big move. Now let's go over to the Thinkorswim platform so I can show you how to trade this strategy. Now there are 2 ways you can trade this strategy. The first way is you can sell a single call option against stock that you already own. If you do this, the strike you choose should be based on where you are willing to sell the stock at. And selling the call will not require any additional capital. Your brokerage firm will recognize that you own stock already, and it will not require you to put up any additional capital to sell this call against your stock, because doing so adds absolutely no risk to your portfolio, and if it doesn't add any risk, then it shouldn't require any additional capital. The second way to trade this strategy is to enter the trade as one position, and also close the trade as one position. I'll show you how to do that now. Let's say we want to buy shares of Apple at the current price of $116.29. And we will be more than happy to sell the shares of Apple if it goes up to, let's say, $119. In this case, we could buy covered stock, where we would buy Apple stock at the current market price of $116.29, and we'd also simultaneously sell the $119 strike call option. All we have to do is right-click the bid or the ask of the $119 call, click Buy, Covered Stock, and the order will pop up to place the trade. Now check this out. This is the cool part about trading spreads. The technology is advanced enough for us to trade the stock and the option that make up this spread with one order, which allows us to just trade the net price of the spread and treat it as one trade. So you can see that Apple stock is around 116.29 and the 119 strike call is around 1. But the platform automatically calculates the net price of the spread as a whole, and you can see that we are buying this spread for 115.28. Now we can change the position sizing to whatever we choose, and it will automatically keep the correct ratio of one contract for every 100 shares. And we can also change the price we want to enter the trade at. And remember, we are buying this spread, so we want to get filled at the lowest price possible. And for this example, we're just going to enter the trade at the current prices. Now, it's always good to do one last check before sending the order and make sure that the spread you are trading is correct by looking at the individual legs of the trade. You can see that we are selling the 119 call and buying 100 shares of stock. So this order is correct, and we can go ahead and click confirm and send. Now on the pop-up box, you can see all the details of the trade, including the buying power effect or the capital requirement to make this trade. In this case, the capital requirement is a little over $3,000, and the max loss is simply the price we pay, right? 115.28 times 100 shares is $11,528. Because if the stock goes to zero, then we will lose the full amount. But of course, this is highly unlikely. Is a company as large and dominant as Apple really going to go to zero? Okay, moving on. The max profit is the difference between the strike price and the entry price of the covered stock, because this spread can't go above the strike price of 119. So if we buy it at 115.28 and sell it at 119, then we will make the difference, which is $372. Lastly, the break-even stock price is simply just the price we paid for the covered stock. As long as the stock price stays above this level until the expiration date, then we will make money on the trade. So that's it. Now we can click send and get in the trade. So alright guys, that's it for the covered stock strategy. Here's a quick overview for you so you can pause the video and review it. If you enjoyed the video, make sure to click the like and subscribe button below. And also be sure to check out our 3 free video series. These videos will help your trading tremendously, and they are completely free. All you have to do is go to our website and input your email, and we will send you the 3 free videos. So I will see you there.